Invest in gold because gold will protect you from high inflation, ensure you maintain the value of your money, appreciate your portfolio in a recession, or if you die, your children will be happy to take care of the gold. You can hear similar advice from physical gold dealers around every corner. Their polished techniques for convincing you to invest in gold are irresistible. But how much truth is there in this? Isn't that a little different? Isn't their motivation mainly to sell? Do you really need to own physical gold? On my channel Invest with Jiri, I discuss long-term money appreciation in stocks, ETFs, ways to save for retirement and much more. In today's episode I thought it would be fun to talk about investing in gold, which is often clouded by vague claim from sellers around how cool it is to invest in physical gold. We'll break down the general asset allocation, show the historical evolution of gold, and under what conditions gold has a place in a portfolio. We'll discuss gold savings products, margins at physical gold dealers, and how to monetize gold. Just yesterday, a friend of mine was convincing me that having a piece of gold tucked into a pillow is actually a great thing in the event of sudden world apocalypse. I guess we know we won't care anymore. Let's dig deeper and think about the pros and cons of investing in gold over the long term. We can divide the assets we buy into those that do not generate any additional income and those that bring us additional money into our pocket while holding the asset. Let's divide them into productive and unproductive. Non-productive ones do not generate additional cash and include gold, cryptocurrencies like Bitcoin, and recently popular or derivatives or diamonds. All of these assets are bought with a view to realizing a profit when they are sold. We simply buy and wait for the price to rise higher than the price at which we bought the asset. The next group is productive assets. For example, properties that we can rent out and get additional income from tenants each month, or stocks that pay a monthly dividend on a quarterly or annual basis. If the company doesn't pay a dividend, it either invests the retained earnings in its business or does stock buybacks to increase the value of the company. Then there are also bonds, whether government or corporate, paying coupons, another form of additional income. In the case of non-productive assets, which include gold, we are talking more about speculation of price movements. We have to sell the non-productive asset at a higher price in the future. Otherwise, the whole investment does not make sense. And as we have seen historically with gold, it can be decades and sometimes much longer periods where gold moves in a price channel or force. In this case, we are unable to realize any profit on the investment. There are also additional storage costs associated with owning gold, and we also have security risks. If we look at the evolution of the gold price on the ETF with the ticker GLD, which replicates the gold futures contracts, we can see that its history goes back to 2005. In this period from 2005 to 2011, gold rose significantly and peaked in August 2011. That's great, but if we had invested in gold at its 2011 peak, we can see that even after 12 years of holding, we would still be at the same price. Of course, if we had bought it in 2005 or 2015, we would be in profit now, but who knows when gold is at the price bottom and worth investing in. Even with all the negatives of investing in physical gold, gold has an indispensable place in a portfolio. For large investors, it makes sense to invest in bars of physical gold. The function of gold in a portfolio is not as an investment, but rather as an insurance policy to protect assets in catastrophic scenarios of war or political regime change. Here I imagine that gold may allow one to leave a given country and start a new life elsewhere. For traditional assets like real estate or bank accounts, this is not possible by definition. The question is whether they will confiscate our gold at the border, right? In what situation is it sensible to invest in gold? If we manage a portfolio in excess of $500,000, I imagine that 5% invested in gold bars may be a reasonable proportion. Of course, 5% is the recommended percentage. We can talk about a range of 2 to 10%, but there are gold savings products on the market based on monthly payments of the gold purchased. You simply divide the price of each 10 grams of gold into monthly installments of 1 to 5 years and thus save for gold. It is a very attractive product and dealers are happy to offer it. The arguments like the dollar collapses, the world ends and other black scenarios are guaranteed arguments. However, believe that much of this is not true. Few are able to realize a profit on gold. This is unfortunately true. If you need to invest in gold and have sufficient assets, consider well the size of the bullion you are buying. The market offers 1 gram, 10 grams, ounce, which is 41 grams, 100 grams or 1 kilogram gold bars. There is no point in buying 1 gram of gold because you can't change anything for it. Sizes in a range of 10 to 100 grams are reasonable. On the other hand, 1 kilogram is already too big and it's a problem to divide the gold into smaller pieces if necessary. The size of the physical gold you buy has a decisive impact on its price. If we look at the bullionbuypost.com website, we see that the price of 1 gram of gold is $72.90. But the price of 1 kilogram of gold, which is 1000 grams, is only $61,541. This means a difference of a whopping $11,359 when you buy 1 kilogram of gold instead of 1001 gram bars. For 10 grams and 1 kilogram bars, the difference is less, $4,409. If you are considering buying physical gold, it pays to think carefully. Finally, let's talk a bit about what selling physical gold looks like when you need cash. Many sellers offer buybacks that are 10% less than the sale price. This means that if we wanted to sell the gold in the turnaround, we would lose 10%. In other words, if we buy gold, its price has to go up 10% to be able to sell it for the same amount we put into it. That sounds pretty disadvantageous, don't you think? Thank you very much for watching today's video. I'm glad you are interested in investing, and if you like the video, please give it a like. I look forward to the next time. Have fun and invest wisely.